is the long-term structural picture, as we've just seen with the discussions around the COP summit, and then there's the shorter-term picture. I think where I would like to spend a little bit more time on is the longer-term picture, if I can. Let's see. Probably not. But the longer-term picture, effectively, as a world focuses on decarbonization, and we saw that again at the COP summit. A lot of focus on what needs to be achieved in terms of renewables, in terms of power storage, in terms of EVs, in terms of all the solutions that you effectively need to reduce emissions and reach net zero. What I find striking is that there is very limited focus on what we actually need in terms of raw materials and resources to accomplish net zero. And it reminds me very much of kind of a dynamic that we have seen play out over the last 2 decades with palladium in the Western world. So if you're looking at the critical raw materials report from the European Union from about 20 years ago, they highlighted that palladium is a critical resource, that supply is very constrained, but at the same time it is required in catalysts. Emission regulations were tightened nonetheless, and what happened on the back? Well, palladium rallied 1,500% in a very short period of time. So I think all of these solutions that are being looked at to tackle climate change are required, absolutely. But there also needs to be an acknowledgement that to get there, you actually need an awful lot of raw materials, and we have some numbers on that going in the following slides. But effectively, this is just a brief summary, right? When you're looking at power applications, automotive, others, you do see that a lot of metals tick the boxes here. And to me, this is always very simple. If you want to take fossil fuels out of the global economy, you have to put something else in. And what you put effectively in are a lot of the mined commodities. And then I think the discussion that we still have with some of the ESG investors then is, well, are the miners investable or not? And I think it's the mining industry is doing a lot, certainly in reducing emissions, but the question of whether they're investable or not is a little bit mute, because you need to give capital funds to the miners ultimately to invest in assets to make sure that you don't have bottlenecks on the way to achieving effectively net zero. And net zero, as the chart on the top left-hand side shows, in terms of emissions, is quite a long way. So when we're looking at the COP26 summit, and whether we think it was successful or not, I think it's very hard to answer straight away, but I think it's good that we have another look at the pledges next year. I think that we talk more seriously about kind of climate financing, that is the acknowledgement that tackling climate change is ultimately expensive, and that you have to put a lot of money into the system, also for the developing countries, to make sure that we can accomplish the climate change. Now, when you're looking at the concrete numbers, and this is the net zero scenario that the IEA has effectively put forward. If you wanted to accomplish net zero by kind of 2050, you really need to strap on your boots right now. I think we're discussing at the moment, when we're looking at the EV sales figures, whether we're going to have an EV sales penetration of plus 30%, minus 30%, around 30%. But reality is that if you wanted to get to net zero by 2050, you should have penetration rates well above 50%, I think. And that has genuine implications then, of course, for the metals demand. The same applies for the renewables. When you're looking at the capacity installations that need to come through over the coming years. And I think particularly on the renewables, what I thought was interesting yesterday is that China's Southern Grid effectively came out in their pursuit of reducing emissions. And when you're looking at China nationwide at the moment, kind of fossil fuels account for 60% of power generation by 2030. Southern Grid said that they want to turn that around and have renewables generating 60% of electricity generation. Now, what does it mean to get there? Well, Southern Grid basically doubles the capex in the next 5-year period compared to the previous 5-year periods. Tackling climate change is expensive, I think, and the chart at the bottom looks at that also then in terms of draw on metals demand. And if you can go through different commodities, but let's just pick a few of them. If you're looking at lithium, for instance, the market was 400,000 tons, has been 300,000 or 400,000 tons in size. If you wanted to get net zero to net zero by 2050, and assuming that you don't change battery technology, demand will be 3 million tons, so 10 times as high by 2030, and will be over 5 million tons by 2050. So it's good that we want to have more EVs on the road, but we also have to make sure that we are not running out of more materials. And I think this is where differences then crop up on how different countries and regions also look at that, particularly on the lithium space. So take China, for instance. China has been a very proactive investor in the lithium space, taking stakes in projects in APAC, but also in Latin America. I think when you're looking at Europe, for instance, Europe until very recently has been relying to 100% on lithium imports and has had zero lithium recycling in place. So is that a position that would make you comfortable against all the supply chain disruptions? Probably not. And I think linked to that, what is happening in Europe now as well is that there's a lot of support, obviously, for the lithium industry. You have 6 of lithium projects in the pipeline, very early stage, but you need to develop them. Pick another commodity, silver, for instance. So when you're looking at the silver market, say it's around 30,000 tons. If you wanted to accomplish net zero by 2050, silver demand from solar panels could be around 8,000 tons by 2030, and annually that is, and 10,000 tons by 2050. And those numbers actually factor in that you have declining silver content in solar panels because of thrifting, but also because solar panels get more powerful. So again, it is possible to get to net zero. But we also should have a honest discussion on what is required in terms of raw materials and whether we are at the moment on the right track to supply sufficient raw materials. And from all the numbers that we do see, it doesn't look as if we are on the right track. And again, in terms of we can show that also in terms of capex. When you're looking at a kind of industry capex, say in the last 10 years, including Chinese miners and Western miners, they've spent around $80 billion annually. And I would say this is kind of a baseline spending to keep the wheels turning. Capex has actually been cut since 2012. So $80 billion, I think, is a baseline spending that you need. Just to satisfy that demand increase that we see on the way to net zero, the mining industry needs to spend $99.5 billion every year on top of those $80 billion, and that's to that extent it's just not coming through. So I think that's certainly a little bit of concern. I think this is a message that we are effectively giving to the markets at the moment. If you're serious about net zero, you need the miners and the mining industry, and they need money to accomplish the investment kind of plans that they have envisaged. But it's not just the demand side, I think, where we do see a lot of developments. It's on demand increases. It's also the supply side. I think when you're looking at steel and aluminum, for instance, two of the biggest emitters globally, you do see a genuine structural change coming through there at the moment. And I think it really started with a capacity cap that the Chinese government put on its aluminum smelters, 45 million tons. And we are very slowly pushing up towards that capacity cap. The only production increases that you see now is effectively coming through by increasing the capacity utilization rate. And this is a chart at the bottom of that slide. And rising capacity utilization in an industry that is a processing industry means one thing: prices effectively have to go up, because the smelters will have more pricing power. And I think to some extent that has been reflected in the upward pressure on aluminum prices this year. And then coming back to the costs of ensuring that we clean up the environment and tackle climate change. It is expensive. When you're looking at China, the government has a 45 million ton hard cap on aluminum production. The Western world clearly doesn't have something like that. But what the Western world has, the smelters specifically, are real constraints in terms of the operating environment. So if you are supposed to build a smelter that runs for the next 50 to 100 years, but you don't even know how your carbon environment looks like in 18 months or in 2 years, guess what? You're not going to make that investment. And I think all we have seen so far, take Alcoa for instance, is a reactivation of smelters that had previously been cut down. Alcoa also said that they need around $2,700 per ton aluminum to justify investment in a smelter. And I think that's a big number, because in the past we could justify investing in a smelter at $2,100 per ton. So the question is, why $2,600? What has driven that increase in the incentive price? And I think the bottom line is, well, decarbonization, right? If you only build a smelter these days, really, if you have access to clean energy or renewable energy. So that's solar, and that's hydro, or that's wind. Century Aluminum actually this morning made an announcement that they've signed a power purchase agreement in Iceland to procure wind power for the smelter there. But effectively, running renewables is relatively cheap. Investing in renewables, unfortunately, is not quite as cheap. And if you run the figures through the lifetime of an aluminum smelter project, assuming that you need to make the investment into renewables, you can show that the incentive price has risen anywhere between $200 and $500 per ton. Hence the requirement of aluminum producers to have higher prices going forward. And I think that's important as well, because we were trading above $2,600-$2,700 per ton this year, but we have already fallen below that. Does it incentivize investment in capacity? Probably not. So you're still on that trajectory where the Chinese government is not investing. The Western smelters are not investing either necessarily. So you have got kind of 2, 3, 4 years now where the market actually does look relatively tight. The first investment in new capacity that has been announced came from Indonesia, and it's Tsingshan, who want to build a 1 million ton aluminum smelter linked to hydropower, but that project will not come through until 2024. So again, talking about the lead times, it is a process that we are going through, and the lead times are certainly quite high. So to me, I think looking at the entire metals and mining space, particularly those commodities that are required to decarbonize, it's going to be a challenge, I think, to make sure that we don't have any bottlenecks. So before I go in the cycle, let me just on the business cycle, one more thing on secondary supply, recycling. There's an awful lot of focus on that at the moment. When I do look at the copper market, look at 2025 plus, right now with the project pipeline that we do see, the only the only way how we can potentially balance the copper market beyond 2025 is recycling. So we need to put, and this is happening already, we need to put much more emphasis on the recycling side of things. In copper, that's relatively easy to do because it's relatively easier to do because it's a relatively mature market. So you've built houses with copper cables for quite a while now. Stripping them out and feeding them back is certainly doable. It's doable also on the aluminum side, and we see how governments and countries are becoming more concerned about scrap. So there's a call from the European Aluminum Association for more trade barriers on scrap exports from Europe. So that's all going into the same direction of boosting domestic supply. But it's much harder to do the scrap to increase secondary supply in some of the newer raw materials that have exponential demand growth, like lithium or cobalt, simply because you don't have the infrastructure in place yet. And well, because demand growth is exponential, right? You're starting from a very low base. So it takes you potentially on cobalt until 2050 to stand a chance that the industry could run almost exclusively on recycled material. So it is quite a steep curve, and that means again that we probably see a lot of investment in. We're already seeing that we see a lot of investment in recycling, but you need that primary material, particularly for the newer commodities in the coming years, as well, to make sure that you don't run out of feedstock for tackling climate change. Now, looking briefly into 2022. I think we've had a very good run on the commodity side. Coming out of the COVID pandemic, I think we never really lowered forecasts during the height of the COVID pandemic, and I think we didn't do it because ultimately it was a deep but also a very short recession. So talking to the US manufacturers, we did see how they were operating very differently last year. For instance, in terms of staff levels, so through furloughing scheme, a lot of the staff was effectively retained, and that meant that production could pick up much quicker. What we've seen, for instance, on the steel side, take the US, is that lead times, which are normally like 3 to 4 weeks, have risen to over 10 weeks on the back of a very quick reactivation of demand, while steel supply wasn't necessarily there. And I think we've seen similar dynamics in some of the other commodities as well. So it was a very pro-cyclical picture that took commodity prices higher. What we see now is that some of that COVID rebound that we had is certainly subsiding somewhat, and the chart on the left-hand side picks up on that, shows one of our business cycle models, and it basically shows that we have been in the last kind of 12 months through a recovery and expansion, and now into a downturn phase, all in one go. And I think the downturn phase, but this is what the chart on the right-hand side shows, tends to be a little bit less bullish for price movement. So there's something that doesn't necessarily make us outright bearish, but I think it does make us, at least for 2022, against a longer-term structural bullish picture, a little bit more cautious. What are key concerns for next year? I think Chinese property is one of them. I think when you're looking at housing starts declining at double-digit rates year-over-year, that's certainly not particularly great. The way the supply chain reacts is potentially also, or normalizes, is potentially also quite important, particularly on the auto industry. You could have a demand boost if we do see a normalization, and there's of say the chip shortages, and there are early signs of that already. And then I think the various stimulus packages that we do see coming through in the US, potentially in China as well, in Europe as well, are potentially also quite supportive. And I think the other thing why I think it's very hard to be very bearish at the moment is just the inventory. Picture. This shows the inventory picture on LME for copper prices. And we have been discussing low inventories for the past 10, 15 years effectively. We never really managed to build inventories. Coming out of LME week, we had a lot of warrants in LME warehouses cancelled, and that meant that the copper that was still available in LME warehouses were actually lower than at the time when the contract was launched back in back 4 years, 4 decades ago. So it's a very striking picture, and I think that has lent itself to a very high volatility as well on the copper market. The LME is looking at how to mitigate that situation, and one solution that was discussed is not letting metals out of warehouses to make sure that you have some kind of baseline copper stock available. It's possible to do that, but I'm not sure whether that makes the LME warehousing system even more attractive or not. I think it makes it probably less attractive. But I think the LME clearly runs the issue at the moment of having it's 2 issues. Having a physically backed contract, which you need if you want to set global reference prices. But on the other hand, the reality is that inventories through the supply chain across a whole range of commodities are actually quite low. And that is a concern considering that we potentially enter a period of much higher structural demand growth going forward. What could save the LME, what could save some of those metal markets is another recession potentially, where you might stand a chance to get some metals back into the warehouses. But with that not being the base case, I think the inventory picture potentially stays quite supportive going forward. And it's interesting, it's not just the LME where we've seen inventories decline. We've also seen it in China this year. So when you're looking at consumer inventories, when copper was trading above $10,000 per ton, I think consumers basically withdrew from the market, and stocks through the supply chain at a consumer level have effectively fallen by half in the past few months to multi-year lows. So replicating kind of the picture that we do see to some extent, or that we have seen on the LME. So the LME, the inventory picture globally remains certainly a little bit of a concern and should overall be supportive for the metal space. And look, I've got 5 minutes left. I thought I stop here, see whether there are any questions. If not, I thank you very much for your attention.
Thanks, Michael. I've got a question down here. Hold on. I'll just write it out.
Just to expose my complete ignorance, but how susceptible is the aluminium production process, both the aluminum and aluminium production process, to the unpredictability, unreliability of solar and wind electricity generation? How do you mitigate and manage that in that process?
That's an interesting question. I think Century Aluminum this morning coming out and feeding their smelter through wind power was an interesting dynamic, because the intermittency issues that you mentioned have always been a pushback for that. The way I would look at it is potentially similarly to what we've seen in the US this year, what we've seen in Europe this year, and what we've seen in China this year. I think there was a lot of focus on renewables. I think there has been very limited focus on energy storage. And I think the energy storage is effectively what helps you mitigate those intermittency issues. And look, we had outages in Texas earlier this year. The Chinese, when you're looking at renewable generation in China, hydro generation in China this year, it's actually down year over year, and there was very limited leeway, I think, for the government. So coming back to the Southern Grid announcement, in their doubling of CapEx, what they embedded in there was a strong focus on energy storage, as well. So I think that ultimately is what you require. Are there different ways of managing the intermittency issues? We have heard nuclear power again, small nuclear reactors potentially being built out there. Certainly possible. Hydro is maybe another option, but again, we're looking at China. If you don't have the rain, then you're becoming an issue. So ultimately, I think you have to make sure, if you want to go fully renewable, you have to make sure, to your point, that you're not running out of power ultimately, and that means you have to have the energy storage in place to get there, I think. So it is, and this is, I think, when you're looking at some of the estimates on the aluminum industry, if you wanted to decarbonize just the electricity sector, the International Aluminum Institute, for instance, estimate the cost to get to a full decarbonization at $1.5 trillion. Come back to what I said before. It is expensive. You can get there, but it is expensive.
Okay, some more questions coming through, real quick.
Just a quick question. Did I hear you correctly mentioning that Chinese real estate market is declining?
Yeah, the housing starts in China have been declining quite sharply. So the government has withdrawn funding from housing, from the property sector, effectively, and they're starting to ease a little bit. But yes, I think that's one reason, I think, why the steel market in China, for instance, is relatively soft at the moment. Housing, generally, I would say, when we're looking at it over the next kind of 15, 20 years, the base case that we have, I don't have the chart with me, is that housing demand actually will decline because of upgrading demand declines, and urbanization, trends in urbanization start to become a little bit less pronounced. Speculation also becomes a little bit less pronounced. And that's an issue for some commodities that rely very heavily on the Chinese property sector, like steel. Take copper, for instance. When you're looking out over the next kind of 15, 20 years, the decline from the housing sector can potentially be offset just because because of higher investment in renewables and higher EV car penetration. So EVs have twice the copper content that a car with a combustion engine effectively have. So it is a headwind, probably will remain. It could remain a headwind going forward. Depending on the commodity, though, there's a good chance that you might offset the headwinds from the property sector, though, going forward.
Okay. Sorry. We've got one more question just here.
Hello.
We're going to take a question here at the back,
Yes.
and then we're going to wrap up.
In view of the current interest in nuclear power, which is probably increasing, would you be able to comment on the outlook for uranium supply and price? So the price has been fairly flat for some time, and yet the impetus for nuclear energy seems to be growing.
Prices have been relatively flat. I think the uranium miners have been. I think prices being flat as such is not necessarily a bad thing as such. I think it shows that the uranium miners have been responsible enough in a period of low demand to shut down big operations, and that has helped rebalance. The market. I think as a starting point, there was a period of oversupply in the uranium market. When you're looking forward, I think you're running into similar kind of issues that you do have in a lot of other commodities. There is a realization and increased discussion right now that you need to have electricity in place that can help you provide a relatively stable base load. And uranium is being seen as one of those. So when you're looking 5-10 years out, the Chinese are investing, the UK is looking into it as well. There's certainly, you can make an argument that the uranium market fundamentally does look a little bit stronger going forward than it does at the moment. Look, a very blue sky kind of application for uranium, our small modular uranium smelters, is the U.S. aluminum industry. U.S. aluminum industry has not been able to benefit at all from shale gas. Nothing. We've seen aluminum production actually come down in the past few months. So actually investing in uranium, or maybe some of the modular smelters there, modular capacity there, that could potentially help bring some production back online. But I think I've run out of time, and I'm holding proceedings up. So
Thanks very much, Michael. Round of applause for Michael Widmer. Michael.